With as many as 3 in 4 Americans living paycheck to paycheck and a third without the income to cover just the basic expenses, everyone needs to maximize their monthly cash flow. Hey Bowtie Nation, Joseph Hogue here, and I usually try striking that balance between portfolio growth and dividend income in most of these videos here on the channel, but your bills don't give a damn about your portfolio. Sometimes you just need that cash flow. And unless you want to start selling your stocks, putting that last nail in the coffin of your retirement dreams, your best opportunity for income is in high-yield dividend stocks. Now understand that the stocks I'm going to show you today may not grow your portfolio like others we talk about here, but they will pay the bills. I'll highlight 7 of the highest paying dividend stocks with yields as high as 14% and how I found them. Our first stock, SLR Investment, ticker SLRC, is the lowest yield on the list at 10.7% dividend yield. I'll be counting up through our dividend list to one stock that pays a 14% dividend and could have a surprise price upside ahead. SLR is a business development corporation, a BDC, making first lien loans to mid-sized companies and has an investment portfolio of nearly $2.2 billion. Along with cash and other assets, the shares have a net asset value just over $18 a share, which means the stock is trading at a 17% discount to NAV, a solid discount which should support the price while you collect that double-digit dividend yield. We're just getting started on our highest paying dividends list, but I don't want you to think we're just looking for the highest yields in the market. For example, the yield on Semper Farfignugan here is 50%, but we see the stock has crumbled by more than half in the past year, and with a daily volume of just 142 shares, good luck finding a buyer. Even something a little more reasonable, like Invesco Mortgage, ticker IVR, with its 16% yield, has seen a pretty tough loss, and if we look at the payout history, has slashed its dividend in half over the last couple of years. That's what we don't want. So I searched the 433 US traded stocks with dividends greater than 8% first for those positive price performance over the last year. These stocks may not take your portfolio to the moon like Nvidia, but we sure as hell don't want to lose that money. That narrowed the list to 261 stocks. Then I narrowed it further to 60 high-yield dividend stocks growing their payouts over the last 5 years. Because your bills grow, so your dividends should grow too. Then with that list of 60 stocks, I narrowed it down to this list of 7 that you can count on to put more cash in your pocket. Next up is one of the most dependable monthly dividend stocks I've ever seen, Pennant Park Floating Rate, ticker PFLT, with its 10.8% dividend. Pennant is another BDC, but specializes in floating rate loans, a unique advantage it's had over other BDCs in the last few years. 86% of the portfolio is in secured debt on first liens, with another 14% in equity investment to give it even more upside growth. That high percentage of loans with first lien status is going to help protect it from any downturn in the economy, while that high equity position will help it rebound later. The company's current portfolio of loans to 141 companies is diversified across more than 30 industries, with an average loan size around $9 million and a 10% average portfolio yield. That first lien status and floating rate, along with the diversification, has helped it double the dividend since 2011. That kind of growth that's hard to come by with volatile BDCs and monthly dividend payers. And next, here's a monthly dividend payer that takes me back to my venture cap days. Horizon Technology Finance, ticker HRZN, with its 11.7% yield. Here we see Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries, a $26 billion addressable market. It's a market that's taken a hit with last year's venture capital crash, but as a former venture capital analyst, folks, I can tell you there is no better market for growth than technology, life sciences, and healthcare tech for business development corporations like Horizon. That portfolio of loans is well diversified by sector, geography, and company stage. You would expect most of the portfolio to be in that Silicon Valley West Coast area, here with 41%, but it also has nearly 2/3 of the company's loans elsewhere in the Midwest and East Coast. The portfolio is diversified across company stage and sector, and all of these are going to be those fast-growing startups backed by venture capital, and again, a great niche in healthcare and technology. So besides that high yield you typically get from the business development corporations, here you get a little bit of growth stock as well. The average yield on the portfolio debt is 16.8%, well above the 12% dividend yield, and one of the strongest spreads I've seen in a BDC stock. That's important because that higher yield on the portfolio versus what the company pays out in dividends means that dividend sustainability you can count on. The company has paid out a cumulative $18 a share dividends, a total return of 93% over the last 5 years, makes Horizon one to watch. We're just getting started on our high yields dividend stocks to buy, but if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You'll see the first stock is immediately, and they'll email you the rest, that full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link or just scan the QR code here. While most BDCs we see are sponsored by smaller companies, you don't get much bigger than Goldman Sachs, and it's Goldman Sachs BDC, ticker GSBD, with its 12% yield. The BDC is similar to PFLT, with nearly all, 99.9% of its loans floating rate for that interest rate safety. It's also got 91% of the portfolio in first lien status, even higher than PennantPark, so this could be the safest BDC on the list. The portfolio is spread across 144 companies and yields 13.2%, just slightly above the dividend yield. So that spread between what the company collects on its loans and what it pays out in dividends isn't as wide as we saw with Horizon, but is better than PFLT, making it one of the safer BDCs I've seen. Now, unfortunately, there's not much dividend growth here, in fact, none, but the company has been able to pay a consistent dividend since 2015 and is trading at strong support around its net asset value. I'm also highlighting PennantPark Investment, ticker PNNT, for its 12.3% dividend, though I'm not sure you need that and PFLT. Whereas PennantPark Floating Rate, the PFLT, focuses on those first lien senior debts, PennantPark Investment is more broadly focused across the capital structure. While 58% of the debt here is first lien secured, it is a little riskier portfolio with 22% equity and 13% subordinated debt. So that additional risk feeds into the higher dividend yield and will generally mean a higher price return when times are good. You see that in the one-year chart here with shares of PNNT up 33% along with that dividend. PFLT is also up, but a more modest 6% on top of its 11% dividend. There's nothing wrong with holding both of these, but for the sake of diversification, I'd probably just go with one or the other. I do like that extra equity kicker with PNNT for the potential upside, but PFLT would be the safer bet for investors that don't want quite as much risk. If we're talking about paying the bills with your high-yield stocks, I want to help you figure out how much you need to invest. So to calculate how much in dividends you're going to collect or how much you need to invest for a certain amount, first, you find the stock's dividend yield here. Here we see Horizon pays an 11.7% dividend, but remember, yields are always shown on an annual basis, so this is an 11.7% yield each year. If we take that yield times the amount we invested, let's say $1,000, or 0.117 times 1,000, we see we'll receive about $117 a year in dividends. Since we know HRZN is a monthly payer, it works out to about $9.75 a month on that $1,000 invested. Of course, you can also take the number of shares you bought times the dividend per share. We can go to the dividend history and see the stock paid a 16 cents per share dividend in March. If we bought 88 shares with that $1,000, then 88 times the 16 cents a share per dividend would have been a $14 dividend for the month. Now that might include a special dividend, so the regular dividend we see here of 11 cents up per share per month would be closer to that $9.70 a month we calculated. Finding out how much you need to invest for a certain amount is just as easy. If you want to make $100 a month from dividends, and let's say you only own that Horizon with its 11.7% yield, then you take 100 times 12 to get that annual amount. So $1,200 you want to make each year, and then divide that by the yield. To make $1,200 a year or $100 a month, you'd need to invest just over $10,000 in shares of Horizon Technology. Now, I would never say depend on all your dividends from just one stock. So what you want to do is get an average dividend yield for all the stocks in your portfolio and use that for your dividend calculation. For example, adding up the dividend yields from all 7 stocks in this video, then dividing by 7 to find that average gives us 12% across the portfolio to use in your calculations. Up next is one of the few mortgage REITs that have held up over the last few years, Arbor Realty Trust, ticker ABR, with its 12.8% dividend yield. Arbor is a direct lender to multifamily properties, most backed by government sponsors and agencies for that safety. Multifamily projects make up about 91% of the portfolio, so it's a little on the high side, but these are all agency-backed loans, so definitely on the safety that you want to see in a mortgage REIT. The company is also heavily invested in the Southeast, with 61% of its portfolio in just 4 states, so again, a little more concentrated than I usually like to see in a real estate investment trust, but this is the growth region for housing, so I still like the stock. Arbor has grown that dividend by 16% annually over the last 5 years and has increased it for 11 consecutive years. Revenue growth of 20% a year and modest dividend growth also puts Arbor at one of the lowest dividend payout ratios among IMREITs. That's a good sign for dividend sustainability. Multifamily properties have seen some weakness this year as rents ease off, but we're still in a huge housing shortage, which should support rents and loan growth for the company. Our next high-yield stock pays almost a 14% dividend, but these double-digit yielding stocks have been known to cut their dividend when times get tough. There's one group of stocks that has increased its dividends for more than 25 years, though, through good times and the bad. Check out this video next, and I'll show you how to grow a portfolio of dividend aristocrats from $100 to $1,000 in dividends each month. You might not have considered Alliance Resource Partners, ticker ARLP, even with its 13.9% yield, but recent news has me taking another look. Amazon's $650 million purchase of a nuclear-powered data center has been a wake-up call for electricity generation. The EIA estimates the U.S. will need to add another 1.3 trillion kilowatt-hours of generation over the next 17 years. Very strong growth driven by booming demand for artificial intelligence and electrification. That kind of increase isn't all going to come from natural gas or renewable energy sources. It's going to have to come from coal as well, and that means the rumors of demise in coal have been greatly exaggerated. And Alliance Resource has built one of the largest coal operations in the eastern U.S., with 7 underground mines expected to sell as much as 36 million tons this year. It's also got royalty interests in strategic oil and gas basins, as well as growth initiatives in renewables. The company has paid out over $4.1 billion in dividends since 1999 and has grown the dividend for the last 3 years. Get your free report, The Stocks I'm Buying for the Next 30 Years, My Forever Stocks, with the link below in the description, or click on the video to the right for the Dividend Aristocrats Challenge and how to build a $1,000 a month portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.